Why 90% of retail traders lose? Most traders think they're losing because of fear, or greed, or bad discipline. But what if I told you, even if you had perfect psychology, you would probably still lose? And I'm not saying this to scare you. I'm saying this because once you understand the real reason 90% lose, you stop blaming yourself and start fixing the right problems. Today, I'm going to break down exactly why most retail traders lose money. And no, it's not because you're emotional. It's because the game is designed in a way beginners don't understand. Let's get into it. Most beginners think trading is simple. Price goes up or down. So it's basically 50 over 50, right? Wrong. The moment you enter a trade, you are already negative because of spreads, because of commissions, because of slippage. Let me explain this in the simplest way possible. Imagine flipping a coin. If it's heads, you win $100. If it's tails, you lose $100. That's fair. Now imagine this instead. If it's heads, you win $100. If it's tails, you lose $103. Suddenly, you don't need bad psychology to lose. You just need time. That's what trading fees do. Every single trade starts slightly negative, and beginners trade a lot. Overtrading plus fees equals slow death. You might be thinking, okay, but spreads are tiny. Yes, on one trade. But over 500 trades? Over 1,000 trades? That edge compounds against you. This is why most retail accounts slowly bleed, not explode. It's math, not emotion. What to do instead? Stop overtrading. Trade only high quality setups. Understand your actual cost per trade. Focus on risk-reward ratios that beat fees consistently. If your system barely works before fees, it will fail after fees. Here's something most beginners don't realize. You are not trading against other beginners. You're trading against high-frequency trading firms, market-making algorithms, institutional liquidity systems. These systems execute in milliseconds. You execute in seconds. That difference matters. Let me give you a simple example. You see a breakout. You click buy, but before your order even gets filled, an algorithm has already detected the same breakout, entered earlier, and adjusted the price. You enter slightly worse. They exit slightly better. You don't notice it on one trade. But over hundreds, that micro disadvantage compounds. And here's the brutal truth. Retail traders don't lose because they're stupid. They lose because they're slower. Speed is an edge, and you don't have it. What to do instead? You don't compete on speed. You compete on patience. Avoid low time frame noise. Avoid scalping unless you deeply understand liquidity. Focus on higher time frames where speed matters less. If you try to play their game, you lose. So don't. Section 3. Your stop loss isn't hidden. Visual. Chart with clustered stop losses above resistance, below support. This one hurts. Beginners are taught, just put your stop loss below support. Sounds logical. But guess what? Everyone learned the same thing. So what happens? Thousands of retail traders place stops in the exact same areas. Below support, above resistance, below equal lows. Liquidity builds there. And large players need liquidity to enter big positions. So price often moves into those areas first. Not because the market is hunting you personally, but because that's where the orders are. You might be thinking, so the market is manipulated? Not exactly. It's just mechanics. Large orders need small orders to fill. Retail traders provide that liquidity. If you don't understand this, you'll feel like the market is attacking you. But it's just structure. What to do instead? Stop placing obvious stop losses. Understand liquidity zones. Look at where everyone else is placing stops. Give trades breathing room when structure allows play. The market doesn't care about your psychology. It cares about liquidity. Section 4, backtests, lie to beginners. Visual, clean, perfect backtest, equity curve. Zoom out to messy reality. This is a big one. You backtest a strategy. It looks amazing. 80% win rate. Beautiful equity curve. Smooth growth. So you go live and suddenly it doesn't work. Why? Because you curve fitted it without realizing when you test something in the past, you're seeing completed data. You can visually avoid bad setups without noticing. You unconsciously filter trades. You optimize indicators for past data. The result? A strategy perfectly designed for yesterday. But markets change. Conditions change. Volatility changes. Your backtest doesn't include slippage, emotional hesitation, missed entries guys, real spread variations. So it creates a fake sense of security. And beginners go all in too fast. What to do instead? Forward test in demo for months. Test across multiple market conditions. Use simple systems complexity fails long term. Expect drawdowns. A strategy that survives imperfection is stronger than one that looks perfect in hindsight. Section 5. Small accounts force bad decisions. Visual $200 account versus $100,000 account risk comparison. This one nobody talks about. If you have a $200 account and you risk 1% per trade, that's $2. Be honest. Are you going to feel motivated making $3 or $4 per trade? Probably not. So what do beginners do? They risk 10%, 20%, sometimes 50%. Now, one bad trade wipes out weeks of progress. Then comes revenge trading. Then comes emotional spiral. But here's the key point. It wasn't psychology that started it. It was unrealistic expectations. Small accounts plus big expectations equals forced over-risking. That's structural pressure, not emotional weakness. Even with perfect discipline, the math becomes brutal if you over-risk. What to do instead? Accept slow growth. Treat trading like a skill-building phase first. Focus on percentage returns, not dollar amounts. Protect capital above all else. Survival is greater than fast profits. Always. Recap the real reasons 90% lose. Let's summarize. Retail traders don't lose mainly because of fear. They lose because the game isn't 50 over 50. Fees create negative expectancy. They're competing against faster algorithms. They place stops where everyone else does. They trust unrealistic backtests. Small accounts push them into dangerous risk. Notice something? None of that is you're too emotional. Psychology matters, but structure matters more. When you understand the structure, your psychology improves automatically because now you're not confused anymore. You're informed. Final message. If you're a beginner watching this, don't quit, but also don't be naive. This game rewards patience, punishes ego, and destroys people chasing fast money. If you want to survive long enough to become profitable, focus on risk control, fewer trades, learning market mechanics, long-term thinking. That's what actually separates the 10% from the 90%. CTA. If this helped you see trading differently, I've put together a free beginner risk management guide. And if you want more no BS trading breakdowns like this, subscribe to the channel because I'm not here to sell you dreams. I'm here to show you how the game actually works. I'll see you in the next one.